The Federal Reserve is going to pivot, what to watch for, and what this means for you. I have all the details and what you need to know right here in the video, so let's get right into it. All right, now this is a very important topic you'll certainly want to watch very closely over the coming weeks and months, especially through the rest of 2022, as it is very likely the Federal Reserve is going to be pivoting on their policies and reversing what they're actually doing. So, in this video, I do want to talk you through all the details about this, let you know what to watch for, and of course what to listen for, as well as what this is going to mean for most Americans going forward. So there's a lot going on right here in this video. Let's jump into it and discuss what the Federal Reserve is currently doing and why this is such a big deal right now. All right, so as all of us know, inflation is very, very high, right? That is no surprise to anybody. Everybody knows what's going on with the inflation situation. Well, as a result of that, the Federal Reserve is aggressively raising interest rates to hopefully lower inflation. However, as I've talked about in previous videos, unfortunately, they are using the wrong tools for the job in order to lower this inflation. The reason that we have so much inflation right now is because we have too many dollars out in circulation. They need to take some of those dollars out of circulation, which will ultimately bring down inflation, but it'll also bring it down very slowly. So by them raising interest rates, it's not really doing anything, right? It's the wrong tool for the job right now. However, as a result of this, with them rapidly raising interest rates from basically zero, which is where they were currently sitting just a few months ago, what they're doing right now is they're raising interest rates very, very aggressively. In fact, at the fastest pace that they've raised interest rates since 1994, 28 years ago. So the fact of the matter is, since they had interest rates sitting so low, zero, they had to raise them very, very aggressively right now. As a result of that, they're going to be taking the economy down with it. So with them raising interest rates at the pace that they currently are right now, they're actually going to be collapsing the economy. Now, do they care about that? Not really. It would seem that they don't really care because the whole idea behind this is to get rates back up so that in the event that the economy falls into a recession, which it is, we need to know that because now they have a little bit of extra breathing room when they need to start cutting interest rates once again and making it more appealing for people to go out and start borrowing money. That's the whole idea behind the whole interest rate game, right? As they raise interest rates, it decreases the appetite for borrowing money for most people. Therefore, the whole idea is that us, the consumer, will stop borrowing as much money, stop spending as much money, therefore leading to so much inflation. But the deal that we're having right now with all this inflation is not because of demand, but rather it is because of too much money supply. So, does that kind of make sense? So anyway, here's what I want to point out for you. Because the Federal Reserve is raising interest rates so incredibly fast right now, the whole idea behind this is they know just as well as we do that they're not doing this to actually lower inflation, but rather they're doing this because they have to raise interest rates up quickly in order to get ahead of the game so that when the whole economy collapses onto itself and we fall into somewhat of a deep or prolonged recession, now they have interest rates that they can once again cut in order to make it more appealing for us to go out and borrow money and or spend money to bring the economy back to life. So you kind of see how this cycle is going right now. So here's what we already know. With the rates that they're currently putting in place right now, we've already gotten some indication that they're likely going to be going into a pause in September. So they do have a meeting scheduled in September, and there's already been indication that they likely will be pausing during that meeting. But here's what's interesting. They've been raising interest rates by 75 basis points here and 50 basis points. So what does that mean if they're going to go from raising half of a point and 3/4 of a point to all of a sudden pausing? What is that telling you about their policies? Well, basically what they're projecting is sometime in late Q3 or early Q4, I would anticipate the Fed is going to come out and say, we overdid it. We raised rates too fast. We collapsed the economy. The stock market is down, 25, 30, 40, 45, 50%, whatever it happens to end up going down. Everything else is collapsing off a cliff right now. We're going to pause. Hey, just kidding. We're actually going to come in and we're actually going to start cutting interest rates now. So that's likely how this conversation is going to come out. Here's what also is interesting as well. We know that this is an election year, right? So in November, we have the midterm elections. Well, surprisingly, we have a meeting right there in September as well, where likely they're going to be pausing on raising interest rates, and then likely the next meeting is probably going to be a cut. Now again, do I have a crystal ball? No, I don't have a crystal ball. Am I behind the scenes hearing what all these people are talking within the Fed? No, I don't. But looking at historic trends and what typically happens on election years and when they are raising interest rates this aggressively, it is very likely that they will probably be pausing in September and likely cutting sometime within Q4 of this year, 2022. Basically reversing the policies that they have in place right here, right now, through the middle of 2022. Kind of an interesting process, right? So the whole idea behind this. Now, I want to throw this out there because here's what we want to watch for. Listen for certain language. If you've ever listened to Jerome Powell, the chairman of the Federal Reserve, speak, or any other chairperson from the Federal Reserve, they speak very carefully. Have you ever noticed how they speak very, very slowly and they monitor every single word that comes out of their mouth? Because they know that every single word that's coming out of their mouth is being digested by investors, Wall Street, all kinds of people are listening very closely. Therefore, they are very careful, right? They tiptoe around with the words that they say because they know that they're being analyzed and everything that they say may give a glimpse into what their plan is going forward into the future. So here's what I want you to listen to, because right now they are doing something called quantitative tightening and they are raising interest rate, right? So they are tightening on policy. In other words, they're raising interest rates and they're actually doing a little bit of quantitative tightening, which is taking money supply out of circulation. However, they need to ramp that up and they need to get more dollars out of circulation to really bring this inflation down. Which, by the way, when I say take dollars out of circulation, I'm not saying that they're going to go into our bank accounts and take our money. That's not how it works. No. So they have way too many dollars floating around in the system, way too many dollars in supply. They need to get some of those dollars out of there because over the last 2 years or so, early 2020 to early 2021, they printed about 22% of our money supply. You've probably heard that before. Some very staggering stats, right? That's a lot of money. About $6 trillion was printed just in that about 1 year period of time. It's a massive amount of money. So anyway, they need to get some of that money out of there in order to bring this inflation down. So that's what I want you to listen for. Number one is when they start to talk about pausing their policy, right? So they use a lot of fancy words, and that's something that they like to say is we're going to pause, things like this, and they'll talk about their policy. So listen for that as well. Next, they might talk about something as far as halting or pausing on quantitative tightening as well. And when you hear the words coming out of the chairman of the Federal Reserve's mouth talking anything about reversing policy and or quantitative easing, or just straight up easing, or what else do they say? Cutting rates, things like this. When you hear words like this, that is basically them coming out saying, okay, we've pivoted and that is it. We are now going to go the opposite direction. Now that they've raised rates so much, now they have just a teeny tiny bit of rates where they can start cutting. Now, generally, they like to start cutting by 25 basis points at a time, which is 1/4%. But depending on where we're currently sitting at that time when they decide to start doing it, maybe they'll start doing it a little bit more than that. But again, they only have so much leeway between where they're currently sitting with their interest rates and zero, right? It's unlikely that they're going to go negative. So the fact of the matter is they don't have all that much room to go from where the current rates are at the time that they decide to start cutting all the way down to zero, right? They won't have a whole lot of leeway to go. So anyway, listen for these words out of the chairman of the Federal Reserve. Now, what is this going to mean for you going forward? Well, as we continue to work through the rest of 2022, as long as they are raising interest rates, that just means that it's going to cost more to borrow money. Whether you have a short-term loan, you have a personal loan, you have an auto loan, or you get a new auto loan, you refinance a mortgage, you have an adjustable rate mortgage, you have a home equity line of credit, student loans, you have credit cards, all kinds of these different products that have either a fixed rate that you're locking in now and or an adjustable rate. Any of these types of financial products that have any type of interest rate attached to them, if you're locking something in now or it has an adjustable rate, you're probably paying significantly more to borrow that money. Well, when the time comes in where they're going to start cutting once again, lowering interest rates, that just means that now once again it's getting a little bit cheaper to borrow money. Like back in early 2021, just for example, a 30-year fixed rate mortgage was sub 3%. You could have gotten a sub 3% mortgage. That's crazy. I mean, seriously, that is unbelievably low, right? So even now, sitting at about 6% or thereabouts, I mean, still it's very high compared to where we were a little over a year ago, but historically it's still very relatively low, right? Again, not too many people are out too interested in locking in 30-year mortgages right now at around 6%, but the fact of the matter is this is something that we got to watch going forward, because as they continue to cut rates, which again, I would anticipate sometime within Q4 of 2022, so honestly, not that far away from now, right? They'll likely be cutting rates once again, so completely reversing the policy that they've had in place. And why would they do this? Because they're going to start to see the economic impacts of this. They're going to continue to see inflation raging on with pretty much no relief from inflation through the rest of 2022, because they're using the wrong tools for the job. So they're going to continue to see inflation raging on. They're going to see the stock market collapsing, the crypto market going down even further than it already is, the housing market put on pause, because who wants to lock in a 30-year fixed rate mortgage or even a 15-year or an adjustable rate mortgage at these high rates right now? Nobody really wants to do that. Of course, some people will, but the vast majority of people don't really want to lock in on these rates. So everybody's kind of sitting on the sidelines right now, just kind of waiting it out for these rates to come back down. And once again, as they continue to collapse the economy and everything else going on, then they're going to finally realize, oh, sorry, we went too far. We raised way too fast. And oh, wait, all of this raising of interest rates did nothing for inflation. By golly gee, what are we doing here? Yeah, exactly. Maybe they'll figure it out. But as a result of that, what is this going to mean for the real estate market, for auto loans, mortgages? What's it going to mean for the stock market and the crypto market, things like this? Which, one quick side note, if you're interested in getting some free stocks, I do have a link down below in the description. You can check that out. Otherwise, I will also pin a comment at the top of the comment section. You can check that out. I have a link there. If you want to check it out, you can get some free stocks if you sign up by using that link. If not, that's totally fine too. Doesn't matter to me. I just want to throw that out there. You get some free stocks if you want to possibly buy stocks or crypto, things like that. But again, you can use that link, sign up there, and you'll actually get a free stock when you actually sign up and deposit any amount. It could be $1 and you'll still get some free stock. So pretty cool stuff, right? So anyway, just want to throw that out there. But what is this going to do to the stock market and the crypto market, the real estate market, things like this? Well, we're probably going to see another very aggressive buying type of situation. Now, here's the thing too. We need to watch how far the markets have dropped by then. Are the markets down 20%? Or are they down 55%? Again, we will know that as we get to that point. Where are the markets currently sitting at that time? Have they fallen off of a cliff? Have they gone down? Are they basing around doing absolutely nothing? Where are the markets sitting at that time? Here's what I would anticipate. When the Fed comes in and starts cutting rates and things like this, and possibly quantitative easing once again, in other words, printing more money, I would anticipate we're going to be sitting in a situation where the stock market is probably down significantly. The reason I say that is because this is what they do each and every time, is when the stock market is falling off a cliff, they decide, let's print up a bunch of money and let's get this thing back to life here. So I would anticipate the stock market is likely not going to be just bouncing around, basing, just sitting around doing nothing. Highly doubt that. It's likely going to be going down very aggressively, very fast, and that'll be their indication to say, okay, it's about time here. Let's reverse on this and say, just kidding, everybody. Let's reverse our policy. Let's start printing a bunch of money again, like we've been doing for the last 14 years since 2008, and go back right on the same track that we were and reinflate the big bubble once again. So the system once again repeats itself, and time goes on, and it's the same old song and dance over and over and over again. We've been seeing it for many decades now. This is what we see every single time. The whole idea behind the Fed is to keep the markets and everything at equilibrium, right? The way that they do that is by adjusting the interest rates, things like this, printing money, not printing money, quantitative easing, quantitative tightening, cutting rates, all these kinds of different things, all these little plans and little projects, little things that they get to do, like all these little dials that they get to turn. I mean, obviously they're not little dials, but you kind of get the analogy here. This is kind of the idea behind the Fed, is they try to keep everything within equilibrium. Well, as a result of that, unfortunately, they overshoot to the upside and they overshoot to the downside, trying to keep everything maintained at that middle line, which is equilibrium. So anyway, this is what you want to watch for going forward. This was what I anticipate based on the analysis, based on historical trends, based on an election year, the midterm elections coming up, all kinds of different things, and what the Federal Reserve has already hinted at, which is possibly even pausing in September, which seems a little bit weird to me considering they're raising rates at a rate of 75 basis points, 50 basis points, things like this, and then all of a sudden to come in and say, oh, just kidding, we're going to pause. Wait, what? Why? It doesn't make any sense, does it? If they're trying to get inflation under control, wouldn't they keep going until inflation is like under control, right? And here's the thing. They said that they want to get inflation down to 2%. Good luck. Yeah, that's all I have to say. Good luck with that one. It's not happening anytime soon, unless they take some really dramatic measures, and that's going to be an ugly situation if they do. So anyway, it's a fluid situation. As I do get more details on any of this, and as more information comes out on this, of course, I'll continue watching it very closely, monitoring the situation, and as I have more details that I want to share with you, of course, I'll be right back here for you in another video, breaking it all down, helping you out in any way that I can, and of course, keeping you updated and giving you the play-by-play as to what is going on. Also, quick side note, full disclaimer, this is not investing advice in any way, shape, or form. I don't know your situation, and I cannot give you investment advice in any way at all, but rather, hopefully I can talk you through the situations of what's going on here, give you some pointers, what to look at, and of course, you can make your own decisions on any investments that you may want to make or that you may not want to make. But again, just want to throw that out there just so that we're all on the same page here. And of course, I'll keep you posted with any further details. So again, please make sure to subscribe down below if you haven't done so yet, so you don't miss any videos going forward during this busy time, and so you can stay posted with all the latest details as we get more announcements and we continue to monitor the Fed as far as what they're doing, and of course, all of the other metrics like inflation, the stock market, all of these other metrics that are going on right now, and how it all is faring during this time. So again, thanks so much for joining me. Subscribe down below, share the video, and go back and check out some of the other thousands of videos here on the channel. Enjoy your day. Until next time, have a good one, and I'll catch you again later.